Thanks for joining us today on Market Call. I'm Morella Fernandez. We have Tim Regan on the show, Managing Director at Kingwest Company. He'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266. You can email your questions today as well, marketcall@bnnbloomberg.ca. Tim, good to see you.
Great to see you as well.
Last year, of course, was very volatile. I'm wondering what you expect this year, whether all of the macro events are going to continue to play out on the markets.
Well, I mean, the only thing we know is we really can't forecast, but it's been a volatile year once again. Speculation is coming and going. We've seen the gold price reach new highs and come back down in the last few days, and now it's back up. So I think the market's kind of finding its own legs. You're seeing a lot of companies I just looked at today. Some companies are up and down 15, 20%. We're talking big companies, worth 100 billion plus. So it's volatile is the word.
Yeah, and I'm just wondering if you looked at the start of the year, so just the first month of January, how would you characterize it?
If you closed your eyes for the whole month, you'd look at it and say the markets were up slightly, maybe 0.5%. That wasn't the real story. The real story was lots of speculation, lots of up and down, lots of whipsawing. And that's why really you have to be a long-term investor.
Do you have concerns about the market being overvalued?
The market itself, if you look at it, there are pockets that are overvalued that take the average price to book of the market up. But if you take away some of those sectors, the market's a little higher than average on a valuation basis, but nothing too terrible. And there's a lot of companies you can buy in there that are great for the long term today. We
saw the broadening out that we started sort of second half of last year. People got, they weren't so enthusiastic about tech. The shine was off, we'll say. Hasn't rebounded in many ways since that point. With that broadening out, are there sectors that you like that you're picking away at?
We're still picking away at sectors, financial. We've even picked away more at the bottom with real estate. Don't forget, we're value investors, so this is the kind of things we do. And also industrials as well.
Have you kept tech at all, or have you moved away from tech?
We have, I'll call them communication services, but we have two stocks we consider tech, which would be Meta and Google in our U.S. portfolio, and we've kept the two.
And have you trimmed, or are you staying sort of where you are with the position?
We're staying with the position, but we did trim about a year or two ago.
Got it. Okay, let's take a quick break then. We'll line up our first phone calls for Tim. He is taking your questions today on North American large caps. He is with Kingwest Company. Here's how to reach us. We're back in a moment. Welcome back. Let's start with an email from Clark. He says, what does your guest think about Micron? Tim, we'll take a look at the Micron chart in just a moment. It is down today. But is this something you invest in, something you like?
We don't own it. And the reason we don't own it is valuation. And if you look at Micron up until maybe, we'll look at the chart, maybe up until 2 or 3 years ago was trading at the same price it peaked at in the tech boom. And it's a very good company. But today, if you can see, it's up 362% in 1 year. It trades at about 41 times earnings. They had a great year. Analysts are calling for the earnings to go up 500% in the next 3 years. I think their earnings will be more than their revenues are today. I think this is, if it comes in as such, maybe it's worth it. But I think this is fraught with risks. You can see it's down a little over 3% today, but I imagine the whole sector is. I just think it's too pricey, and one earnings misstep will hurt not just Micron, but a lot of the stocks. I think Micron's now at almost $500 billion of market cap. Oh, look at that, 3 years. So we should have owned it 3 years ago. But as you can see with the chart, if I had been in for 3 years, I'd be taking profits now.
Yeah, you're right. They're at 474. For market cap, so almost at the halfway point. Okay, let's go to our first caller then. Costa is on the line. He's in Montreal. Hi, Costa.
Thank you for taking my call. I would appreciate your knowledge on my beautiful company, CSU Constellation Software. It's very hard to predict the future. but do you think she's almost at a bottom?
Well, Costa, I'm glad it's your company, and so obviously you own it. And Constellation is a fantastic company. It's down, if the chart comes up, it has to be down 50% from its peak. And it's a great company. We think it was pretty pricey, up above $4,000. It's now coming back into a range that it looks good to buy at. Is it going to bottom out? I can't tell you that. But as I said, we're value investors. And if you really want to be a value investor, you want to buy a good company when it gets cheap. And I'm going to tell you right now, Constellation is on the screen for us. Can't tell you what we're going to do, but I don't know where it bottoms at. But when you get an opportunity to buy a decent company at this price, you usually take it.
Can you just give us a wider view on how you feel about software in general, given what's going on with Thomson Reuters today? Do you have those same software company concerns?
Sure. I mean, we don't have any software right now, and it was just the valuation. And I think, when you look at everything, and I haven't seen everything with Thomson Reuters today, but people take the individual companies and think they're going to dominate the market. It's a highly competitive market. Some are better than others. Constellation rolls up a lot of small companies and grows. But you're starting to see valuations more like a competitive market in some of these areas. And so, this is what we'd expect to happen, that you'd get some sell-off and blow-off. And when this happens in that area, you can pick up the better ones for a decent price. So that's what I think we're seeing right now, and over the last 6 months or so.
Okay, let's go back to the phone line to Ross on the line in Windsor, Ontario. Hi, Ross.
Hi, good afternoon. Thank you for taking my call. I'd like to guest's opinion on Onyx Corp. I'm a long-term holder, but it hasn't really done very much for this last year or so. So I'd like his opinion on that. Thank you.
Okay, thank you for the question. Let's get to Onyx. What do you know about Onyx?
Well, Onyx, we used to own in the past. We don't own it today. That doesn't, mean that it's not a good hold. We do own Brookfield, Apollo, Blackstone, and KKR. So we're loaded up with the private equity firms. Onyx has done a relatively decent job, but if you look at it over the course of the year, compared to the other names I mentioned, other than Brookfield, the American ones anyway, it's held up relatively well. And I think that there's a big sell-off in the private equity, private credit space that's gone on for a while. And so with Onyx, if you're a long-term holder, just let it compound. And so Onyx, we don't own it, but it's not a bad company and it's not too expensive.
Okay, that was for Ross. Let's go to Deborah in Okanagan Falls in BC. Hi, Deborah. How are you?
Oh, hi. Good morning. Today, my question is on GM. I bought GM in the high 50s, and I've held it for several years. With the recent earnings and the 52-week high, I actually trimmed my position to put some cash in my pocket. My question today is, where do you see this share price going in conjunction with the sector?
Okay, yeah. Thank you for the question. Also a complicated sector because of tariffs and Kuzma up for negotiation.
Tremendously complicated. If you look at it, GM's done quite well. And when you look at our whole supply chain with Kuzma, it's hard to forecast what's going to happen. So when I look at GM, you say, should we buy it? Should we sell it? What should we do? I call it 10-foot pole territory because it doesn't mean that it's bad, but just because the future is so uncertain because of macro events. They're running the company very well. But with the macro events, why take a chance and have it go against you? And so, for now, taking some of your profits in GM is probably not a bad thing.
Okay, let's take a quick break. We'll come back with more of your questions for Tim Regan of Kingwest Company. Again, he's taking your questions on North American large caps. Here's the number to reach us. We're back in just a moment. Stay tuned. Welcome back to Market Call. Let's get to an email from Alex. He says, good day. Can I get your guest thoughts on BYD, thoughts on EV markets in Canada and its competitiveness with regards to Tesla in Europe and abroad? BYD, a Chinese company, makes very inexpensive EVs, and Canada, of course, going to allow just under 50,000 of them into the country with a new deal with China. What do you think of BYD?
Well, BYD itself is a Chinese company. It trades, I think, on the Hong Kong exchange. And as an investor, you don't have to venture any further than the North American or European markets. When you go to the markets like that, they don't have the same rule of law. So investing in a company that looks great on an emerging market, I know Hong Kong's not really emerging markets, but on a foreign exchange where, how shall I say, the rules might be rigged a little more against you, we just avoid that like the plague. And if you look at it over time, if you went in a time machine back to the early 90s and saw what China has done from a business economic point of view, you would have thrown all your money into the market, which was Hong Kong. I think you would have made a 3% rate of return compounded annually. So just the companies and the stocks are two separate things. EV markets themselves seem to be, every time we turn around, we hear of another Canadian plant that was about to do EVs and is now closing off, or battery plants. We've had a fairly cold winter. Go talk to a Tesla driver on how their power is. So EVs will always be around, but I don't think the consumption will be quite what they were. And we're allowing 50,000 of these cars in, which isn't a lot at all. And we'll see how the cars do. But as an investment, I don't think we would even look at this.
Okay. Let's go then back to the phone line. John is on the line. He's in London, Ontario. Hi, John.
Hi, Marella. Hello, Tim. Tim, it's RRSP contribution time, and I'm thinking of adding to Google, which has been a steady riser for me for about 4 years. It seems to be resistant to some of these pullbacks that we've seen, and it has a lot of irons in the fire. Would I be better off adding to Google, or should I pick something that I think is undervalued, like the KKR that you mentioned? Thanks very much.
Okay, thank you for the question. What do you think of Google? I said you own it.
We own it.
Yes.
It's a big position in our U.S. portfolio these days because it's growing so much. If you look at the chart, it's fantastic. It doesn't trade too expensively now, and they have a lot of irons in the fire, as it was said, whether it's their core business, self-driving cars, all their different, we'll call it Google, their different bets, so to speak. Right now, do you want to add more to Google or not? If you can look out 5 or 10 years, sure, but maybe this is a case of you just have Google for a little more diversification in the portfolio, maybe going with a company that isn't in the same space as Google and you like as well. But that's more of we'll call it a diversification element today. But, all I can say about Google is we continue to own it, we continue to like it, and we think it has a lot of upside still.
Okay. That was for John. Let's go to Michael in Vancouver with a question. Hi, Michael.
Hello, Marella. Hello, Tim. Tim, thanks for taking my call. Tim, my question is on Berkshire Hathaway. This past few months, Mr. Buffett has stepped down, and basically has held its own, but it has dropped a touch. Wonder what your thoughts are, since sometimes the market can be a little bit more emotional rather than thoughtful. I just wondered where you see Berkshire heading with both Charlie passing away and Warren stepping down. How do you see the future? Okay. I'll hang up and listen to your response. Have yourselves a great day.
Thank you for the question. Berkshire Hathaway started trailing as soon as he announced he was retiring. Now that's done. Do you see a turnaround for them?
Well, it's Berkshire Hathaway is, today, I guess we'll call it more than Warren Buffett. Berkshire Hathaway is really an investment portfolio wrapped in an insurance company. And I don't want to say it's on autopilot, but you have a Greg Abel taking over, who seems to be very capable. You have a great collection of companies and assets. It's an enormous company with a lot of cash. And if you want something that's going to, I don't think Berkshire will outperform, so to speak, the S&P. Even Warren Buffett said it. We've gotten so big we can't outperform the S&P. That's over longer periods of time. But for a quality asset going forward, There's not a lot of risk to it, and there's decent growth. And Greg Abel and other people replacing Warren Buffett, if he thinks they're good enough and he still has his money in it, they must be good.
Okay, let's take a quick break. Then we will take a look at Tim's past picks when we come back. Welcome back. Time to look at past picks from Tim from November 19th of last year. So just a few months ago, Strathcona was the first pick, SCR on the TSX at 42.81, now to 26.08, 39% decline. Total return down 15%. Strathcona, of course, was in a bit of a bidding war to take over Meg Energy. Is that what hit the stock?
What hit the stock really was it is down 15%, but they declared a large dividend, a $10 dividend, because of the money that they accumulated through the MEG. And so Strathcona as a long-term holding is great. The chart looks like it's fallen off the face of the earth, but it's really, it's down probably essentially $5 or $4.50. And because of that dividend, and we think going forward, it's a fantastic company, and you're just going to be at the whims of the oil market going forward. But as a long-term play in the oil patch, it's great.
Have you remained invested in Strathcona?
Absolutely.
Okay.
This is times when we look at it, and sometimes we can pick up a little more at these prices.
Okay. Let's get to your next past pick from November. Quebecor, QBR.B on the TSX, 52.40 a few months ago, down to 50.88, so 3% return drop and a return drop of 2%. Tougher business model these days with Quebecor and some of these companies, but are you holding on to what you have?
We are. We quite like Quebecor. They are eating away at some of the bigger companies and running it very efficiently. I guess there's a theme here from November that all the companies are down, but I always like to say, when we talk about companies, we look about 3 years out. We don't know what the short-term pattern is. And usually if you hear me talking about something and 3 months later it's down, we're either still hold it or we buy more of it unless something material has changed.
Okay.
And so Quebecor is still a long-term hold.
Okay, let's get to your third pick then from last November, Blackstone. BX on the New York Stock Exchange, so 138.65 and now to 136.44, so 2% return drop on a total return of 2%. I imagine you've held on to Blackstone. Give me your longer term sort of thesis on this, because it is one that people tend to invest in longer, isn't it?
Sure. Longer term, we bought this right after the Great Recession. When it came out, was public at 30. I think we bought it at 20. We've held on to it. It actually has a decent dividend. It's a little sporadic. It was an LP at first. And as you can see, it's got knocked again today. But you're talking about, $1 trillion business that does private equity, credit, all the alternatives. And it's interesting because when we say long-term, we did a synopsis of all the large publicly traded private equity, private credit alternatives firms, asset managers we'll call them, and looked at their LPs versus their actual stock price. And over time, the share price actually outperforms the LPs. So people go in thinking I'll get 11, 12, 13, 14%, which they do, not mark to market. That's where the big pensions go in, but you're better off with a stock for returns. The problem is they're very volatile. They're at the whims of the investors. You can see them move up and down 40% in inter-year periods. So these are long-term holds. Sometimes you trim when they're at the top. Sometimes you buy more at the bottom. But they're very stable businesses that get traded in a market that makes them look very volatile.
And it's a 4.5% dividend, so you're getting that payment sort of as you hold.
Yes. And people forget a lot of them too. The dividends sometimes will go up depending on their realizations. It hasn't been a great time for private equity firms. I'll use private equity, not just credit, to sell off companies and then make their fees and pay them to investors. So we're going through a bit of a cycle in their business, but for the long term, it's still a great hold.
Okay. Let's take another break. We're going to be back with Tim Regan, Kingwest Company, taking your questions on North American large caps. Back in a moment. Welcome back. Let's go to Faisal on the line in Toronto. He's got a question. Hi, Faisal.
Hi, Mirella. Good afternoon to both you and Tim. So my question is on Colliers. Mm-hmm. It sold off sharply this morning, and there's news that they've acquired an engineering firm called IESA, which Jay Hennick seems to be very positive on. Can I get your thoughts in the light of the sell-off? I don't know if the market is mispricing it or whatever. Would this be a good buying opportunity? I'll hang up and listen. Thanks.
Okay. Colliers was a real estate group?
Yeah, thanks, Faisal. Colliers is a company we own. We've owned it for a long time. You mentioned Jay Hennick, one of the best CEOs going. Colliers, everybody feels that they're someone who sells real estate, but really they're into engineering, as you found out. They also have an asset management business where they actually own student housing. They own Air Force housing in the States through one of their arms. And Jay's done a wonderful job at buying smaller businesses and tucking them under. So yes, I don't know what really happened with the price today, but I've seen prices all over today. And when you get this on something that, might be inconsequential, I haven't seen I do know they buy engineering firms almost every day. I'm being a little facetious. But it's a great business for the long term. And once again, it's almost like Blackstone. It's going to be very volatile, but over the long term, it's one of the best compounders the TSX has known.
Okay, let's go to an email then from Mary. Mary says, may I please have your assessment of CGI Inc.? It is back down to where it was in 2022, but I haven't heard anything as to the cause. You think it's a good investment at this time? Tim, what can you tell us about CGI?
Yeah, well, with CGI, I'll admit that I don't have a lot of insight into what the business is doing today. But if you look at the sell-off, we looked at Constellation before, a lot of the different software companies, computer companies, and there's been a huge sell-off. Part of it was, if you go back prior to a year, there was a huge run-up. So right now, what's happening is the market seems to be pricing this whole area perhaps in our opinion, a little more rationally, and it does provide some opportunities. I can't tell you whether CGI is a good buy today or not, but it certainly was a better buy than at the beginning of 2005. And so I think a lot of the downfall is just due to valuations in that sector coming back down. Maybe they're cheaper than they should be, but at minimum, they're in line.
And because you think it's more, the trend down is what was needed in this part of the sector, would you buy in, or do you think it's going to be a hold at this point?
We are looking hard at this sector. The hardest thing is to ever buy things at the bottom, but this is a sector that has good businesses. It has prices that were unaffordable to us before. The prices are coming in line. And really, when you look at it, you just have to make sure that the industry is still in place and intact. You have to look at their position in it, their business, and if everything is the same, these tend to be very decent entry points for companies like these.
Okay. Let's go to an email from Duncan. Could I hear your take on Canadian Railroad, CP and CNR at this level? Both of them have tracked down quite a bit last year on transportation concerns and tariffs. Both did just report as well, and some some reason for optimism. But are you invested in either of the railroads?
We do own CPKC, as we call it now, not CN, not a, you can't own them all. And with CP, we think the long term is great, but you're right. It depends on what's going to happen with tariffs, with CUSMA. CP has a railroad that actually extends from Mexico into Canada, but they're doing volumes in different places. They were doing volumes in agriculture. And for the long term, we think that CPKC is a great company. And once again, we're at the mercy of, we'll call it macro political events, which in our view as investment managers, that's tough to call. Mm-hmm. It's very capricious. You don't know what the guy with the red tie will do tomorrow.
So I take it you've held it for a while. Did you trim it all last year? Were you worried about the last year up and downs?
We were, but you just, you have to ride it out because you don't know what's going to happen. We think that, abandoning any free trade between all the nations is just silly and stupid. And so we just still think it's a game that's played. And there will be a resolution. Maybe we're being a little more naive, but there will be a resolution one way or another.
Okay. Let's go back to the phone lines then. We have Sal on the line. He's in Vancouver with a question. Hi, Sal.
Hi there. Yeah, my question is on Netflix. I was interested to know if this is a good entry point into Netflix, given the large drop that's happened recently. Thanks so much.
Okay, thank you for the question. Do you like Netflix? I have mixed opinions on Netflix from different analysts, but obviously it's been off on the bidding war. It is for Warner Brothers.
Well, we don't own it at all, and we tend to avoid it. It's always been fairly expensive, and also in an industry that can be somewhat complex, even though it sounds very simple on the surface, but with accounting and everything else. But I must say that Netflix has come down enough that it pops up on some of our screens saying this is worth another look. Beyond that, I really can't comment. I mean, Netflix they've done a wonderful job with their business, and once again, you're seeing the sell-off of something that perhaps just got a little ahead of itself right now. So I'm sorry that I can't offer you a better opinion, Sal. But once again, if you see it, it's still fairly expensive. We just have to, we'd want to take a deeper look before we make a larger opinion on it.
When would it get more interesting to you? Because it's at 80 now, it's off, and you said you're watching.
Well, I mean, one thing that happens too, when share prices react to changes in the business, then we can follow it. Sometimes the share prices will react and the business is great. Sometimes they're actually telling you something about what people think about the business. And a lot of the businesses that we're seeing today have had great 5-year runs. In many cases, we think they got a lot ahead of themselves. And could they be at a reasonable level today? Yes, but they tend to, when they correct, they tend to overcorrect. And that's the great buying opportunity. So in our mind, I think a lot of the sell-off in some of the areas in the market that was a lot more speculative is still not over. And, we'll only know when it's over in hindsight, but I believe that some of the sell-off is still not over.
Okay, that was for Netflix. Let's get to an email from Shiraz. I have no exposure to U.S. banks. Do you like ZWK or FFN for yield and appreciation? Also, how about ZWE? So basically an ETF that looks at U.S. banks and sort of mimics their stocks.
We have a couple U.S. banks, JP Morgan and Citi, the larger ones. So we do like U.S. banks. U.S. banks have really didn't have, other than perhaps JP Morgan, Citigroup's come up a little bit in the last few years, but the businesses have been growing and the share price hasn't been moving with them. If you look at it as well, some of the small or mid-sized regional banks in the States are once again becoming acquisition targets too. So we think that this space is pretty good. You're in an ETF, so you have a whole bunch of them. It's not a bad sector to be involved in today and for the longer term.
Okay, that was for the ETFs for American Bank. Let's take a quick break. We're back with more of your questions in just a moment. Stay tuned. Welcome back. We have William on the line in London, Ontario. He has a question today for Tim. Hi, William.
I'm trying to decide, should I buy Royal Bank or Bank of Commerce? If you have a suggestion, please.
Okay, thank you for the question. Which would you go with?
Well, William, I don't know what's going to turn out to be right, but we do own the Royal Bank today, and we don't own Commerce. Commerce is actually a very decent bank, but the Royal Bank is absolutely the best-run bank in Canada. They are a fantastic franchise. They've been doing well in the States with their investment banking. And so as a long-term play, the Royal Bank, you're seeing a one-year return of 31%, pretty good. I think they're the most expensive of all the Canadian banks, but they kind of deserve that premium for how they run their business. So what's going to do better going ahead? I think both will do well, but we own the Royal Bank, so I'll stick with that.
Just wondering, because you said it's expensive, would you wait for a pullback? You don't necessarily see that in the banks?
It's more expensive than the other banks, and we think that the banking sector is still fairly reasonable. I mean, our banks earn over 20% return on equity just in their domestic business. Royal, probably even more than that. They do so well domestically. They chug along, they give a great dividend, or at least a decent dividend. And until the Banking Act in Canada changes, they're the best oligopoly going.
Okay. Let's move on to Mike in Toronto with a question today. Hi, Mike.
Hi, can I ask about SmartCentres REIT? It's a fairly steady play. Do you think it's a good buy here, or should I look into something with a little more potential upside maybe, but more risk?
Okay, thank you for the question. SmartCentres, of course, does sort of retail areas or retail spaces. You're liking real estate a little bit more now.
This is one of the companies we own. If you look at management, Mitch Goldhar has done a tremendous job. One of the things about REITs today, if you look at them and they have private real estate, they sell a lot of that in Canada. The valuations, there's a huge discrepancy. The private ones are marking it to their IFRS value. The REITs are trading well below that, huge discounts. In fact, SmartCentres, I think, is about a $35 IFRS just on their real estate portfolio. But one thing that Mitch has done is above a lot of his SmartCentres, he's now building condos. He's got a whole bunch that are ready to go on that new Eglinton LRT that might open in 28? No, next week.
Next week, fingers crossed, yes.
Fingers crossed. And what he does is he just gets his zoning. He doesn't start building, so he's not at risk. And that is a long-term option that goes above and beyond that, call it that $35 a share. So we own it. It has a decent dividend, in fact, better than most. And I'm saying it's a great long-term hold for you there. And the other thing too, when you look at, you say something with more risk, I think there's a lot of things with more risk, but they have the same upside potential. So don't look at risk. You want less risky and more upside potential. And this is what this does.
Let me ask you about retail wider, since they do the real estate for retail, and whether there has been a noticeable push back to people getting into stores to buy things as opposed to online. Because, of course, that was the problem for so long, is everybody was online.
Well, I mean, just go to shopping malls these days. And it is. You're absolutely right. And in fact, SmartCentres, their anchor tenant is Walmart in most cases. And Walmart's doing great. They just passed $1 trillion in market cap today. That was early this morning. God knows where they are now. But so, when you look at it, everybody has to buy things. They have to eat, grocery stores. They do a lot of storage now as well. It's a great long-term play.
Okay. That was from Mike. Let's get to an email from Ian in New Brunswick. He says, Meta recently delivered blockbuster earnings and the stock jumped on the news. Would you still be adding at these levels? Meta, one of the Mag 7 that is making money from its AI investments in curated ads, essentially. And investors liked what they saw in the most recent earnings. Do you like Meta?
Another company we own is, our two U.S., we'll call them communication service tech companies, are Meta and Google. Meta is actually, as you can see, it hasn't done much, even though it's jumped up. So it's up 1% over the year. It's the cheapest of all the Mag 7s. I'm not sure where the P is today, but the forward P is, I think, under 20 times. It's a cash flow machine. And so when you look at something of that quality and you can buy it at a muted price, it usually works out well over time.
Do you have concerns about overspend in AI? They pulled back spending. They are cutting spending in some of its divisions, the reality. But, they have what they have, and they're spending a lot of money to build out AI.
Well, it'll be interesting because once they peel back on spending on AI, you're still getting that cash flow gushing in. And what do they do with that now? Does it just make them more valuable or not? So a lot of the AI isn't really priced in. Some of it is, some of it isn't. But when something is trading, at 20, 25 times earnings, and they're plowing back most of it into AI, it still means they have great earnings power, even at that level. So the AI bet, some will work, some won't. I mean, that's just how it works. But they're pretty sharp people, and that's why they spread it around.
You mentioned you're in Meta and in Google, which is Alphabet. Are those the only two, you call them communications, but tech?
Only two tech stocks we're in. Some, people mentioned some today. Some are getting interesting now that they sell off. And so, we've always found that tech, and we bought both of them in March of 2000. They were on sale. That's one maybe tip I'll give to people. If we do see a sharp correction, don't be afraid to walk into good companies, even though pessimism's at its worst.
Are there one or two you can tell us that you're watching and they're getting interesting to you?
One was Constellation. Done a lot of work on it, getting interesting. Lots going on there. The founder kind of retired. And so there's a lot of elements that we like to look at and get to know the business a lot better. It's one of the things we do. We really want to know what the business plans are going forward. Can they execute it? And does that translate into a higher share price? So we're doing the work right now.
Got it. All right, let's take a quick break. When we come back, we'll have new top picks from Tim. Back in a moment. Join us tomorrow on Market Call. Cole Kasher will be with us on the show. He's Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. He'll take your questions on North American stocks and ETFs. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time for some new top picks from Tim. We're going to start with Amrise, AMRZ, on the New York Stock Exchange. You're going to have to explain a little bit about who they are, what they do.
Sure. Amrise is really aggregates and roofing. People know them better. People don't know Amrise. It's a new name and it's a spin-off, but it's really Lafarge North America. So if you've been by quarries around where you live, half of them are Lafarge anyway. So it's a very large company. What happened was Lafarge was bought by Holcim in Switzerland. And then this is a division that's a spin-off. And that just happened in the last 9 months. Fantastic business. The CEO from Switzerland came to North America and bought North America to run it, bought $100 million of his own money into the stock. It trades fairly reasonably. We think that this company, and they do a lot of acquisitions as well, so it's a better known company than people think, but a new name. It will be about $120 in 3 years. Next 3 months, I don't know, but 120 in 3 years. But if you look at infrastructure build out, they're going to be at the forefront.
So mostly through sort of government contracts, that kind of thing?
Contracts, everything. Aggregate cements, whether it's private, government, and it's all over North America. They do as well. They're huge into the roofing business as well. And I think the market cap is about $40 billion.
I think they just had it at $30 billion, yes.
$30 billion, thank
Okay.
you. 30 billion US. And so nobody knows this because it was just spun off. Some of the financials are a little, I won't call them wonky, but when they spin stuff off, they tend to throw the kitchen sink out. And as the company grows and builds, you'll see it some of the cash flows start to accelerate, and people will begin to understand it a little more. And perhaps as they understand it more, the share price will rise as well. But we think this is very cheap for the long term.
Okay, let's get to your next new pick, which is EQB, which is EQB on the TSX. They've been in the news a little bit here and there as they tried to gain some share in what is a difficult sector. You like EQB, why?
We talked about banks. They're the challenger bank. They've been through a lot of struggles. Some of it was, due to loan loss provisions. Their CEO passed away unexpectedly.
That's right, yes.
But the big thing that's happened with EQB, we've liked them for a while. They got into an agreement with PC Financial, and they bought PC Financial. They have access to a whole host of clients, including, I didn't realize 14 million people have PC Optimum cards. They can cross-sell against those people.
Yes.
And that's going to be a big thing as they grow, and perhaps they can break into that six-bank oligopoly. They now have more services. They were really just deposits and mortgages and home equity lines of credit before, and now they have credit cards. And that's a big thing for financial companies to do. I mean, even ourselves, we're moving into the mutual fund business. That's a whole new lineup for us, and now making some of our stuff available to the public.
So you see them getting a boost from buying PC Financial and having that access?
Incredible boost, and they're a well-run company, and they're highly digitized. So, they don't rely on branches at every corner. They're the best at online.
Okay, let's get to your last top pick, which is GFL Environmental. GFL on the New York Stock Exchange. They are a waste management, hazardous waste as part of that, and are really off since summer, we'll say into summer there. But you are looking to pick this up. Do you own it? What are you doing with this?
We own it, and we have. This is another long-term business where they do a lot of what we'll call it tuck-under acquisitions in that space. And, if you have a garbage depot, garbage dump, you can buy the little trucks around it and the little companies, and it's very accretive. They've been doing a great job at that. They keep expanding. Recently, they moved their headquarters to Miami.
Yes.
And some of that is so they can be listed and get more U.S. shareholders. Some of that might be because our taxes aren't great here. I don't know that about the people, but you're going to see a lot more of that, I think. And so we think it's a great long-term pick. It's a little cheaper than the rest of the waste management companies that are bigger waste management companies, and it has a longer runway to grow.
It was off, as I mentioned, as of last summer. Any particular reason for that?
Some of it was idiosyncratic. Some of it was the industry. There were different things off and on, but nothing that was, in our opinion, a major long-term impediment to growing their business further.
How long have you held it?
We've held it now for almost 5 years.
And you didn't do anything last year when it went down, you just held on?
No, we just held on. One of the tricks to investing, I'll just say this here, is sometimes if you have a great company that can compound and create value, you can trim a little bit, buy a little more when it's down, sell a little when it's up, but keep it. It's, you don't know what the market's going to do from day to day to the company, but as long as the business is on track, the industry is on track, buy and hold it forever, get to know the company better, and you'll make a lot of money that way.
Okay, that was for GFL Environmental, GFL on the New York Stock Exchange. We're going to leave it there. Tim, thanks very much for joining us today.
Thank you. And one last thing is a shout out to my wife. Happy birthday, Nori. It's her birthday today.
And we won't share how old Nori is.
39.
Oh, well, 39 again. Excellent. Thank you very much. Thanks for joining us today.
Thank you.
And thank you for joining us as well. We will see you back here again tomorrow.